Welcome, trader friends. This is the gold thesis, which goes along with Friar's silver thesis video from yesterday. And this one has the potential to be a super kahuna. Gold is currently at $429.89, which is up 89% in the past 12 months and up 8.6% year to date, even after the Hormuz ceasefire speculation knocked it lower from January highs. This thesis rests on 6 structural pillars, all confirmed. The headline driver is US gold revaluation mechanics. Treasury Secretary Barron may be able to revalue the gold certificates without legislation, using powers already embedded in 31 USC 5117 and the Gold Reserve Act of 1934, and the implications are enormous. The trade vehicle, Friar's trade vehicle for this is the gold October 16, 2026, $430 call, $470 call, bull's call spread, with break even around 446. Max profit at 470, and we would be looking at taking early profit. So here I want to present some evidence to back this up. Quick snapshot: gold is GLD is at $429.89. Gold spot is $4,721. The all-time high from January 26 was $5,602. GLD for the past 12 months, is up 42.7%. Probably the most important number on this slide is the $42.22. That's the statutory price at which US has booked its 261.5 million troy ounces of gold, a price set in 1973. The book value of gold reserves is approximately $7 billion. The market value is approximately $870 billion. That gap, $860 billion of unrecognized value sitting on the US government balance sheet, is the foundation of the revaluation thesis. Goldman Sachs, JP Morgan, Citi, Bank of America all have $3,500 to $4,000 price targets for gold this year, and we're already past some of those. The revaluation case, if Barron moves the statutory price to market, is $10,000 to $20,000 per ounce. A $5,000 revaluation alone would create approximately $1.3 trillion of new assets on the Treasury Fed balance sheet without printing a single dollar of new debt. 6 pillars, all 6 confirmed. Importantly, the gold thesis is structurally different from silver. Silver is a supply physical squeeze story. Gold is a monetary reset story. The 6 pillars span economics, geopolitics, sovereign policy, and market structure. The revaluation mechanic is the headline, but what I want you to understand that this trade works even if Barron never touches the statutory price. The other 5 pillars alone, central bank buying, de-dollarization, safe haven demand, fiat currency debasement, and the comments options market signalling, are sufficient to sustain Friar's bull thesis. The revaluation is the nuclear option. The other 5 pillars are the structural foundation of trade. Pillar 1 the revaluation mechanics. This is the pillar that makes gold different from every other commodity or macro trade. The United States holds 261.5 million troy ounces of gold. It's carried on the books at $42.22 per ounce from 1973. Gold's currently trading at over 4,700 per ounce. That's a gap of greater than 11,000%. The critical question is whether the statutory price can be moved. Treasury Secretary Besant has publicly referenced monetising the asset side of the US balance sheet. The legal mechanism already exists in USC 5117 and the Gold Reserve Act of 1937, I think. The path being explored is not a legislative revaluation. It's an accounting mechanism that could be activated by the Treasury without congressional approval. Also, the Bitcoin Act, under committee consideration, explicitly references revaluing the gold as the funding mechanism. That is on the public congressional record. And then there's the COMEX data. Open interest in December 2026 gold calls at $10,000, $15,000 and $20,000 strikes. Someone with significant institutional capital is positioning for a step change in gold price. They're not buying these contracts for a laugh. The premium cost is serious. Someone knows something. Barron. Pillar 2, central bank buying. In 2022, central banks purchased 1,082 tonnes of gold, and that was the highest level since 1967. In 2023, they bought 1,037 tonnes. In 2024, 1,045 tonnes. 2025, 1,190 tonnes. 3 consecutive years above 1,000 with acceleration. What are the central banks doing when they buy gold? They're replacing dollar-denominated assets on their balance sheets with an asset that has no counterparty risk. It cannot be sanctioned. After the Russian reserve freeze in 2022, every emerging market central bank received the same message simultaneously. Dollar reserves can be confiscated. Gold in our vaults cannot. China is the clearest example. The US Treasury holdings at the lowest level since 2008. China's gold reserves are at 2,306 tonnes. They've been purchasing every single month in 2025 and continuing and increasing in 2026. The substitution is explicit. Dollars out, gold in. Central banks are not traders. They do not make short-term bets. When they add 1,190 tonnes of gold in a single year, they are making a structural statement about the future of their monetary system. In fact, the global monetary system. Pillar 3, de-dollarization. The Russian reserve freeze of 2022 was the moment that changed everything for non-Western central banks. Over $300 billion of Russian sovereign assets held in dollar-denominated instruments, for example, T-bonds, were frozen by the stroke of a pen. Every central bank in the world received the same message. Do not hold your reserves in dollars. Gold cannot be frozen. Gold cannot be sanctioned. Gold has no counterparty. It is the only true reserve asset on Earth with those properties. China has been buying gold every single month and selling treasuries. The BRICS nations' architecture for trade settlement in non-dollar assets is developing, with gold as the neutral layer, as the backing. And the data from the US export statistics tells a remarkable story. Non-monetary gold made up roughly 90% of the rise in US exports in late 2025. Gold is being physically moved to settle trade imbalances. The China pays in gold thesis is not confirmed, but the circumstantial evidence is building. And if this is correct, the US government has a direct incentive to keep gold prices elevated. A higher price means fewer tons needed to set a given dollar deficit. Washington may be running a higher gold price as policy. Pillar 4, safe haven demand. Gold is insurance against the unthinkable becoming real. And at the moment, a remarkable number of previously unthinkable things are real, are happening. The US-Iran conflict, Hormuz closed, so the world's most important oil choke point under active and continuing military threat. Every previous Hormuz crisis or oil crisis has driven gold higher. Russia-Ukraine continues with no resolution in sight. US-China tech war is escalating with chip export controls and potential Taiwan risk. The US national debt at close to $37 trillion and growing at over $2 trillion per year. There is a risk to this, and that's the bottom right, the taco risk. A formal ceasefire or US-Iran deal would cause a sharp near-term gold sell-off. We saw exactly this happen in April when the war exit speculation knocked gold from $445 to $429. However, Friar thinks there is very little chance of a US-Iran peace deal, while a nuclear issue is totally, each of them are at different ends, and of course the wild card BB. Okay, here's a critical point. A geopolitical resolution does not fix de-dollarization. It does not undo the central bank buying trend. It does not close the $860 billion gap between book value and market value of US gold reserves. The safe haven demand is one of the 6 pillars. The other 5 remain intact, regardless of what happens in the Strait of Hormuz. Pillar 5, fiat currency debasement. With the US national debt at close to $37 trillion and growing, the Federal Reserve's balance sheet expanded from under $1 trillion before 2008 to over $7 trillion now. Every dollar of new debt issued is a claim on future purchasing power that may not materialize. Gold is the historic answer to this problem. In every fiat currency system that has ever existed, gold has eventually repriced upward to reflect the purchasing power destruction of that currency. The dollar has lost over 98% of its purchasing power against gold since the gold standard was abandoned in 1971. There is no credible path to US fiscal sustainability without either monetization or printing to pay the debt, or revaluation, inflating asset values to make the debt look smaller. Gold benefits directly from both outcomes. And critically, Treasury Secretary Besant has explicitly stated a weaker dollar is desired for trade competitiveness. A weaker dollar means a higher gold price in dollar terms. The US government is not fighting the gold price. It may be encouraging it. I hope so. Pillar 6. And this is where the COMEX story really gets interesting. COMEX data is the most striking short-term signal. Open interest for the December 2026 gold futures calls at $10,000, $15,000 and the $20,000 strikes is at historically anomalous levels. With the current gold price at $4,720, these strikes are 112% to 324% out of the money. The premium cost to hold these positions in any meaningful size is substantial. That would suggest these aren't retail traders. I don't know any individual investors that would buy $10,000 strike December gold calls in a meaningful size. These are institutional positions. Someone with a lot of capital and potentially with non-public information is positioned for a significant rise in the gold price. On the policy side, the architecture is being constructed. As mentioned in silver, the US-EU Critical Minerals Action Plan signed last Thursday, and the border-adjusted price floors are under negotiation. Treasury Secretary Besant has made repeated references to monetising the asset side of the balance sheet. The statutory revaluation remains pending, but the legislative and administrative infrastructure being built around it makes it increasingly likely. Okay, the algorithm. Step 2 of Friar's doctrine. GLD is at $429.89. RSI at 40.3. So getting closer to the oversold territory. But it's in a confirmed bear trend. Stochastics at 8.15, below 10, one of the lowest readings in the 2026 data cycle. These two together in a bull trending instrument with confirmed MACD crossover is historically a high probability entry zone. The MACD cross is confirmed. MACD X across equals 1. The crossover happened in early April. The recent price dip from 445 to 429 is a pullback within the bull structure, not a trend reversal. The algorithm is currently showing weight. The system wants to see an RSI bounce back up above the 42 to 45 range before generating a full entry signal. Okay, we wait. A 1 sigma call strike from the algorithm, which is $501.35, well above the 470 short leg of our proposed bull call spread. The algorithm's own projection covers the spread width. GDX is confirming the same picture with the RSI at 42, stochastics 19.5. Bull trend. Miners are telling the same story as the metal. The trade structure. GLD October 16, 2026. 430 call, 470 call, bull call spread. The debit structure defined risk. Why a call spread rather than outright call? Because the spread funds itself partially. We sell the 470 call to reduce the cost of the 430 call. The maximum profit is $4,000 minus the net debit per contract. The maximum loss is the debit paid, no margin required. Why October 16 expiry? This is a structural thesis, revaluation, re-dollarization, central bank buying. These are not 35-day to expiry events. 173 days gives the thesis time to develop, captures quarter 2 and quarter 3 earnings and macro data, and positions ahead of any year-end policy announcements. The break-even at approximately $446 means GLD needs to recover from $429 and add $17 from the current position, with the RSI at 40 and stochastics at 8. That's well within the algorithm's projected range. Entry trigger, waiting for RSI to bounce above 42 to 45 range. So we're one signal away from full confirmation. Okay, to finish up, the world's largest sovereign gold reserve is carried at 1973 price, and the man who can change that is sitting in the Treasury. Okay, we've got the 6 structural pillars. They're all confirmed. The revaluation mechanics, central bank buying, de-dollarization, safe haven demand, fiat currency debasement, and the COMEX signal that something dodgy is going on. The algorithm is one signal away from the full entry confirmation. The COMEX signal is the one that stays with the Friar. Someone with big money is betting a lot. And in the current circumstances of dodgy trades around Trump, I think this is a pretty good hint. Okay, JP Morgan said in 1912, gold is money, everything else is credit. I think he's right. So we're ready. Position size, thesis, structural, time. We've got time for this to come. If anyone's got questions, I'm on the Discord. Thanks.